SIP investing won't make you rich, at least not the way most people do it. If you've been investing, you'd have probably noticed something very frustrating in the past 3 to 4 months. The markets have been falling and so has your portfolio. Your returns, just like my beard, would have probably vanished. And if you started a year ago, your returns might already be in the negative. Even if you've been investing for 2 to 3 years, your profits have likely taken a big hit. In fact, you've been lied to about how SIP investing works. So in this video, I'll break it down and share 5 key things that you must know about SIP investing to actually use it to build wealth. Hello everyone, I am Udayan Adhye and I've been licensed in Indian financial services since 2015, and so far I have helped over 1,500 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. First up, finance creators and influencers have made it seem like if you don't start an SIP as soon as you start working or at a very young age, you have absolutely got it all wrong and you would lose lakhs and crores of rupees. And that's true. Starting early is beneficial. I won't disagree with that. For example, if you start a 5,000 per month SIP at the age of 25, you would have 4.98 crores at 60. The same SIP started a year later at the age of 26 would be worth 4.39 crores. Now that is perfect math of compounding. But it's important to know that every person is at a different stage in life. They have had different life experiences, responsibilities, and various kinds of challenges to overcome. So if you're feeling left out and like it's too late to start, don't let such videos hold you back. The key is starting whenever you can and then optimizing your investments from there. In fact, I would argue that if you're under the age of 30 or can save less than 5,000 rupees per month, you shouldn't even invest all of it for your long-term goals just yet. That's because that money can be better spent by investing in yourself. When you're young, the stock market isn't your biggest wealth creator. Your career and your skills are. Think about it. Would you rather have 15 or 20% returns on a portfolio of 1 lakh or a 50% growth in your salary or income? If you're in your 20s, your biggest wealth building tool is not SIPs, it's your ability to earn more money. So instead of blindly investing 5,000 per month through an SIP, what if you spent a portion of that on a course, learning a new skill, or even a side hustle that increases your income? Your future SIP amounts would be 5-10 times bigger because you simply made yourself valuable first and thus earned more money. In fact, let me share this, right? Let's say you are doing a 5,000 per month SIP and that grows at 12% per year. Even after 1 year of somehow managing to gather that 5,000, even after 1 whole year, your estimated return is only 4,000 rupees. And even if you increase the time horizon, your return essentially is 37,000 rupees when you've invested 1.8 lakhs. Even if you get a very high return, that changes things a little, but it's not going to be life-changing money, right? You've put in 1.8 lakhs over 3 years and your return is 68,000. Over a 1 year period, even with a 20% return, which is extremely high by the way, you'd still have just made a little less than 7,000 rupees. Now, of course, while you're building a skill set, trying to increase your income, you should still have an emergency fund that ideally covers 4 to 6 months of expenses at least, and also get a health and term insurance. Maybe you can also start a very small SIP for your long-term goals, so you get an experience, a taste of actually seeing your money rise and fall, which will just help you in the long run when you start investing higher amounts. But majority of that surplus, invest that in yourself. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Now, the second thing you should know is how an SIP actually grows your money. So if I tell you that a 5,000 per month SIP with a 10% annual step up would grow to 4.4 crores in 30 years, that would seem like a lot. Of course it is, right? 4.4 crores is a lot of money. But it's important to understand how your money actually grows to 4.4 crores. So let me actually share that journey with you, and to make it very interactive and for you to get an exact idea of how your money would grow, I have used Claude AI. And this shows the journey of a 5,000 per month SIP since 1995 February in the Nifty 50. So there you go, right? You start investing money. You can see you've invested a total of 18 lakhs. The portfolio value over this 30-year period is 1.69 crores. So, massive jump. And the portfolio average return has been 12.46% annually. If you had invested the same amount in an FD, that would have grown to 58.85 lakhs. Now, whenever you see a number like this, it seems like a lot, like I mentioned, but just see how this money grows, right? It's a very smooth line. It's a very smooth line, gradually going up at the start, and then about 15 odd years in, it really starts curling up in a big fashion. Now, what if I tell you though, that this is not how your money grows, and that is why investing in SIPs is very difficult, and that's a lie that you have been sold. The actual portfolio value, if you look at this, right, the actual portfolio value is a very jagged line. At times, it is under this very smooth 12.46% return. At times, it is higher. But at times, you'll notice that it really goes down. Like, look at this, right? During the COVID crash, your portfolio, you'd have invested a total of 15.5 lakhs at that point in time. The average return would have meant that your portfolio is at 93 lakhs. Instead, it is 58 lakhs, right? Imagine that, the big difference. Let's try to change the dates and also figure out how it would look like over a 5-10 year period, because that is what truly keeps us excited. That is what helps us stay invested, right? So let's look at a period between, let's say, April 2010 to April 2020. Now here, let me also add FD returns. I've considered a 7% annual return so that we get a direct comparison. Now let's look at this, right? Over this entire 10-year period, after you have somehow again managed to save 5,000 rupees, you have really been at it, you've seen your portfolio value go up, but at the end of the 10-year period, you have invested about 6 lakhs. That has only grown to 6.83 lakhs. The average FD return as well is much higher at 8.65 lakhs. And at these points, it can feel really hopeless, right? A return of 2.4% annually. It's laughable, right? Especially after 10 years. So just imagine the pain that you would have felt at that stage. Now let's say it's still invested for 4 more years till April 2024. And then look at how your returns would have drastically changed, right? You have invested 8.4 lakhs. That has grown to 21.9, almost 22 lakhs, whereas the FD is at about 14 lakhs. But imagine the pain after the 10-year period. It would have been very easy at that time. Remember, it was a very hopeless situation, right? Everything was shutting down. We did not know what COVID was. But imagine what happened if you just stayed invested for 4 more years. Your return would have been 12.74% annually. You'd have made now almost 2.5-3 times the money of what you'd invested. And it would have again been higher than your FD value. Now, this becomes very important to understand, because this smooth line just makes it seem like SIP investing or investing in general is a very, very simple journey. You just keep investing, your money keeps growing, but in reality, the money doesn't grow in a smooth manner. It goes up and down, up and down, up and down. Most people, right? Most people quit their SIPs before they even see real wealth. And you saw why, because at times it can get very painful. They actually have 3 very distinct phases. And if you don't understand them, you might exit just before you see your portfolio start compounding massively. To understand these 3 phases, let's actually look at how an SIP in the Indian stock market would have performed. So let's say you have an SIP of 10,000 per month and you continue with it for 7 years. So you've invested about 8.4 lakh rupees. That has grown to over 17 lakhs. So your gain is about 8 lakh rupees. If you invest for 7 more years, that is 14 years in total, your portfolio jumps to 45.7 lakhs, which makes the gains 28.9 lakhs. If you continue for another 7 years, that is 21 years in total, your portfolio explodes to 1.26 crores. That is a gain of over 1 crore. That means over 70%, 71% to be very, very specific, of the total gain came in the last 7 years alone. This was a wonderful perspective shared by Radhika Gupta, MD and CEO of Edelweiss Mutual Fund. This is not sponsored by them, but this was an excellent data point. Now, what's the biggest takeaway from this? That SIPs do not make any meaningful wealth in less than 6-7 years. SIPs are designed to compound your money over decades, not just a few years. And this is because the real magic of compounding happens in the later years, like we saw. So think of SIP like a marathon and not a sprint. The longer you stay invested, the bigger base you build, and then when the market grows, the bigger your wealth grows. So remember, the first phase of 6 to 7 years of starting an SIP can potentially give you high returns in terms of percentage, but the actual money growth that will happen, it will almost feel like your money hasn't grown at all just because you have invested a lower amount. This phase potentially starts off with a person feeling excited and hopeful as they start investing, but it ends with this very frustrating dread that their money isn't growing. And what may make this even worse is that during this time or before the start of phase 2, the market may actually go down or correct big time, which just makes this feeling grow bigger. You also may tend to think that investing in FDs like we saw could have been a better idea, and that is why most people give up before getting to phase 2. Now, in the second phase, if you have stayed invested, this phase is from say years 7 to 14. This is the time when you have matured as an investor. You have kind of developed patience. You know how markets work. Sometimes they go up, sometimes they stay flat, sometimes they go down. But somewhere, even after or during the second phase, you still feel like you're not getting life-changing returns. And that is when phase 3 comes in. A time that absolutely belongs to you, where you get rewarded for doing all the right things. This is where real wealth is made. And this is how your investment of around 25 lakhs over 21 years grows to 1.26 crores. Now here's an SIP journey metrics by Funds India. I know it looks complicated with just the amount of data that you see on screen, but I want to highlight something here, right? The way this works is, if you invested in February 2000, over 1 year, what would your SIP return have been in the Nifty 50? If you stayed invested for 10 years, what would the annual return have been? So if you notice, after investing for 4 years, you would have never had negative returns if you had invested in an SIP in the Nifty 50. But we don't want just negative returns, right? We want sufficiently high returns. So just look at what happens when you start increasing your investment horizon. So if you had stayed invested for 10 years, at any point since February 2000, the lowest amount of returns that you would have gotten would have been 9% if you had started in February 2006. But just look at it. If you had just stayed invested for 1 more year, your annual return would have been 10, then 13, and then 11, 12, and high returns after that. When I mentioned high returns, remember the Indian stock market, like we saw, has done about 12.4% if you had an SIP in it. So anything in the range of 1% there is what you should expect for your long-term goals. But I just picked the worst example, right? February 2006, when you had the lowest returns. But if you just look at other starting points, right? So if February 2000 you had started, you would have gotten 20% annual returns, which is excessively high. You shouldn't be expecting those high returns anyway. But no, start of phase 3, that is when the real money is made. Look at this. The returns range from anywhere between 11, 12% to 17%. And they keep getting more and more stable, right? As the investment horizon increases. So they stabilize around a 14, 15% mark, which is again something that you should remember as you invest through an SIP. So finally, with all this being said, how can you use SIPs right now when the market has been crashing? Now I've seen this firsthand with clients. Every time the market crashes, there is panic and people think about stopping their SIPs. And this is happening right now as well. For example, in January 2025, over 61 lakh SIPs were discontinued, about 56 lakhs were started. So there was actually a net decline of 5 lakh SIPs. Now this means more investors are quitting their SIPs than those who started new ones. Even though the SIP contributions in total across India remain strong at over 26,000 crores, this spike in cancellations suggests that investors are getting nervous, and it's understandable, right? Because the markets have not been doing well. But here's the thing. This is exactly when SIPs work the best, and let me prove it to you. I'll share an example from the 2008 financial crisis. Imagine you had started a monthly SIP of 1,000 rupees in January 2005. The market peaked in January 2008 before crashing by almost 60% by the end of October 2008. Now, if you'd invested a lump sum just before the crash, your portfolio would have taken almost 3 years, 34 months to be specific, to fully recover. But if you continued your SIP, right, through that crash when the market was going down, you would have recovered in just 18 months, so almost half the time. Now, the reason for that is because during the crash, your SIP kept buying stocks at lower prices. So whatever amount that you are investing, you're able to buy more units. So when the market finally went up and rebounded, your portfolio value shot up much faster than the Nifty itself. Then the second strategy here is an answer to a very common question that I get asked. People often say to me, okay, great, I will be patient and invest money for 10, 12 years. But what if the stock market crashes right when I need my money 10, 12 years later? Now for that, there's a very simple strategy. All that you have to do is 2 to 2.5 years before your target goal, you either redeem 50% of the money you need or even the entire amount you need. This way, you lock in whatever rate is prevalent at that time and you're not at the mercy of the stock market falling in the future and your investment value lowering. But if there is a crash, let's say 2 years before you need the money, just when this strategy gets implemented, you can simply wait out 12 to 18 months for the markets to stabilize or recover, or even just make partial redemptions. And finally, a lot of people are worried, what if I start investing at the wrong time? Should I wait further for the market to go down even more before I start my SIP? And I get it, right? Nobody wants to invest just before a crash. But let's look at what would have happened if you had done that. There was a beautiful study conducted by White Oak Mutual Fund that looks at a 28-year period and it compared two investors. The first investor, Investor A, started their SIP at a market peak right before a crash, whereas Investor B started their SIP at the bottom after the crash had already happened. Let's again look at the 2008 financial crisis. Let's say you started an SIP in January 2008, right at the peak of the market. But within a year, everything crashed. By March 2009, the market had fallen nearly 60% from its peak and it would have felt like the world is ending, right? Imagine the market going down by 60%. You might think that your investments would have been ruined. But here's what would have happened. If you had continued investing till December 2024, that is for 16 years, you would have invested a total of about 20 lakhs, but that would have been worth 72 lakhs, delivering an annual return of 13.5%. Now let's imagine a different scenario of what investor B did. Let's say you waited for the crash to end and you started your 10,000 per month SIP in March 2009 at the absolute bottom, right when the market started recovering. This would have been the best possible timing, right? You were getting stocks at dirt cheap prices, buying at the best possible valuations, but by December 2004, your returns would have been only slightly higher at 13.6% instead of 13.5%. And here's the crazy part, right? Even though you technically had better timing, Investor B's portfolio ended up at 61.7 lakhs, which is over 10 lakhs lower than the person who started at the peak. The difference here in returns was just 0.1%. But the difference in the final wealth was 10.5%. And this was again true because the first investor just had built a higher base for the money to compound more when the market started going up. And this has been true since all major crashes since 1996 and not just the 2008 crash. Remember, the best investors aren't the ones who try to time the market. They are the ones who stay in it. Whether it is going up or down, they just keep investing because in the long run, time beats timing always. If you enjoyed this video, then watch this one where I talk about systematic withdrawal plans or SWPs, where I tell you how you can generate a regular income from your mutual funds.